Good afternoon, everyone. Mid-July market update, as we promised. A lot of stuff going on today. I'm Woodall. I'm joined, as always, by Mike Rarey from CAP STRAT. Hey, Mike.
Hey, Will.
It's hot in July.
It sure is.
I mean, it's been hot weather. We've had a lot of Gulf weather. We got some hot number this morning on inflation. So we're going to talk about that hot number. But first, July's been off to, in the market context, it's been off to sort of a interesting start. Low volume, markets generally up.
Very few traders actually at their desks during the first couple weeks of July, as you normally see. So any volatility, anybody has just attributed up to this point to low volume. So equity slightly positive, bond prices slightly positive. The only thing that's really been down thus far in July are commodities. So not a huge update from the last time we looked at U.S. equity index technicals.
Which is the commodities being down is a sign of things that we're seeing trends changing. And the biggest thing we got this morning was this unexpectedly hot inflation print. So if we throw up the next chart and look at the inflation shock.
Yep, the inflation shock continues. So headline CPI year over year for the month of June just came in this morning at 9.06%. So continuing to be in a high and rising regime, just continuing to defy expectations. The monthly inflation data has exceeded expectations every single month since August 2020. Nobody has forecasted this.
Right.
And so, you know, even the Cleveland Fed, who does inflation nowcast, their estimate was 8.7 for the reading, and it came in at 9.1. And they have extremely good forecasting accuracy historically. So just a continuation of the trends we saw from the May report, with headline continuing to defy gravity, still high and rising because of food and energy prices, and core continuing to roll over, but slower than the Fed would like, and reinforcing everything the Fed has feared and their change in policy stance this year, feeling more and more justified, probably feeling like they need to do more.
Right. So core was down just a hair, right?
The year over year in core came down slightly. That's 3 consecutive months where the year over year core number has decelerated. High and falling for core, high and rising for headline.
Right. So let's look at some of the details here. In the heat map for CPI, as Mike said, food and energy, unbelievable still. Housing. So take us through the main takeaways from
the big things that really matter. Food. So if we look at the headline number, 9.1 up top, first line item down is food, 10.4% year over year. And it doesn't matter if you're eating out or you're eating at home. Both of those numbers coming in at fresh highs, year over year highs. And energy. So, gas prices, even though we saw, so this is very interesting. Food and energy both at new year over year highs in the headline number, even though during the month of June, we saw gasoline prices start to roll over and come down, and food commodity prices come down, and energy commodities come down. But there is a lag, right? Commodities move first, and then pricing of things consumers actually buy start to change.
Right. And what is that lag generally?
It's usually only a couple months. I mean, pretty quickly, once oil prices fall and crack spreads come in, gas prices get adjusted pretty quickly. So we would expect, and the Cleveland Fed now also expects in their new nowcast, that, I'm going to say it again, June was the peak for headline CPI. But, high conviction view loosely held, because this data has been beating expectations nonstop since August 2020. So that's the bad news in the headline number. And then in the core number, the biggest single line item in core CPI is shelter. And that's rent, owner's equivalent rent, et cetera, up 5.6. That's a new year over year high. So that is what the Fed is worried about. They probably thought to this point they had done enough to slow housing prices, which then should result in rents softening. And we did see some anecdotal evidence of rents starting to soften in some areas during the month of June, but still on a national average level. It's not coming down.
Not happening. And what's the lag time on that?
first thing the Fed can try to do is stop housing prices going up. Rents follow housing prices by about 18 months.
Yeah, so it's a while.
Right. So,
yeah. Okay. So we've shown this chart. I think it's going to come down eventually, right?
yeah.
Let's talk about the path of inflation that we see. Our forecast generally has inflation decelerating at a pretty quick pace.
Mm-hmm.
Why is that versus what we're seeing where it's still seemingly going up?
Yeah. So at risk of sounding like a broken record, the higher prices are now, the more likely it is that the year-over-year change will be lower 12 months from now.
Right.
Every time we get a hotter than expected inflation print, the base effects are just going to be stronger. It's going to be harder for housing prices to go up at this rate again because they already went up so much. Right? Same thing for food and energy prices. So that's one reason. The second reason is as inflation gets hotter and hotter, the probability of a soft landing decreases. The probability of a hard landing increases.
Mm-hmm.
If the Fed is going to defeat inflation, they are simply going to have to do more. And in terms of raising rates, reducing the size of their balance sheet, et cetera. And so this path that we see, it reflects both of those things. The fact that base effects are getting even stronger, and so it should come down quicker later. Probability of a soft landing is decreasing. Probability of a hard landing is increasing. That blue line down, that happens in a recession.
So the first part you mentioned, that's just math, right? It doesn't really affect people. It's just the math. The second part affects people, where the Fed is going to push, and the recession indicators are going off,
mm-hmm.
and the demand equation has got to come down substantially.
Yep.
So they're pushing harder against demand.
Yep.
That's really going to affect outcomes, right?
Yep, exactly.
So let's talk about the Fed and the Fed fund futures curve, which is saying that the Fed might have to reverse course here.
Yeah, what we've seen, so this is what the Fed funds futures market expects the Fed funds rate to be at various points in time. So we have all the meeting dates out to early 2024 labeled here. And what we're seeing now is an extreme front loading of rate hikes. And this is a visual representation of hard landing probability increasing, soft landing probability almost going away.
Right.
This blue line, you can think of it basically as the economic cycle. When the Fed is hiking, they are reducing demand. They're going to end this hiking cycle in December, is what the market is now calling
mm-hmm.
for. The Fed funds should peak at a little over 3.5% at the December 14th Fed meeting. From there, the market is expecting basically stagnation, but if anything, some cuts,
mm-hmm.
because the Fed usually cuts rates in a recession. So absolutely fascinating to see how the slope of this line has changed throughout the year. We were, 9 months ago, this line was up and to the right.
Right.
It would be a nice, long, slow, steady rate hike cycle. Totally the opposite now. Fed funds futures curve is inverted. The market is thinking 83 basis points worth of hikes at the July Fed meeting. So, on the fence between a 75 basis point and 100 basis point hike. And then they're wrapping it up in December. One of the fastest, most aggressive rate hike cycles in history if this plays out.
So if you're going to read between the lines in the last two graphs we just showed, where's the breaking point? I mean, this is suggesting there's probably going to have to be some significant downward pressure on growth.
Yes.
Or else either this forecast is wrong, or our inflation coming down forecast is wrong.
That is exactly right. So if this implies that demand or economic growth is going to slow dramatically by the end of the year into early next year,
mm-hmm.
to the point where inflation is going to slow dramatically. And that will allow the Fed to stop hiking. And that is what the market believes.
And so what does this imply in terms of where inflation will be at 3.5%?
The year-over-year numbers will probably still be high, but that is sort of implying that by the time we get into early next year, the month-over-month numbers might be coming in flat or negative.
Right.
Or at least in line with target, if you were to annualize them. But that basically says the Fed is going to defeat inflation by the end of the year. And that's what the market thinks. So the month-over-month numbers at that point should be flat or negative.
Right. And then how realistic is this? Because if the Fed starts to cut again, aren't they just refueling the inflationary fires?
So that's also very interesting. If you focus on the curve after December, it used to be more downward sloping, which was saying, all right, we're going to have a short, sweet recession. It's going to be mild. The Fed would overhike and then they would cut and everything would be great. But now it's less downward sloping, implying the Fed is not going to cut as much coming out of this economic slowdown that you could argue they're manufacturing, because they're afraid that if they cut too quick after this hiking cycle, then what if inflation is not dead and it comes back and they undo all their hard work? And so that's very interesting. We haven't seen that in a long time.
Right.
And we can talk about that when we get into liquidity, what that looks like, because that's what we're really talking about here is after the growth slowdown, what's the liquidity regime going to look like?
The path of liquidity is still looking a very all-time low. There's not much we can say except that's probably, if we hit those numbers, that's going to be an all-time low in liquidity.
Yep, a dramatic slowdown. More and more, what our models are suggesting, it's been suggesting the slowdown in liquidity that we're in the midst of right now for quite some time. But what was more important, after liquidity bottoms, what happens? Historically, what we're all used to is we have a slowdown in liquidity because the Fed is hiking. They overdo it. We have an economic slowdown. Then the Fed is so quick to cut rates and increase the size of their balance sheet. And we get fiscal stimulus coming out of that economic recession. And so you get a V-shaped rebound in liquidity and markets come back. And COVID, that was tough for a month, right? But it was only a month for markets. That is not what's being suggested this time around. Because this, if the recession materializes, this is an inflation-induced, policy-induced recession. The Fed would be much slower to cut rates coming out of this type of an economic slowdown. They would be much slower to add to their balance sheet again. Liquidity could just stay low for a really long time, and that's something we have not seen basically since we've had our model, since we've been tracking money supply.
It's usually brought back up to the long-term average relatively quickly.
Right.
All right, so let's turn to growth. We had a negative GDP print last quarter. The Atlanta Fed forecast for the current Q2 quarter is negative 1.2 or 1.2%, which would suggest we're already in a recession. What is happening with growth now, and where is it headed in the next 2 or 3 quarters?
The growth momentum throughout calendar Q2 slowed dramatically. And so now we're looking at what the Atlanta Fed thinks the Q2 number is going to be when the BEA releases it at the end of July. And it is negative. And this is an estimate, so there's forecast error. But we're only 2 weeks out from the real number.
Right.
And this far in advance of the real number, their forecast error is about 0.9%. So even if they're wrong, you'd still likely be negative. And so that would mark a technical recession, as you said. And what's basically happening here is the consumer spending data just continues to lose momentum and come in worse than expected. And no doubt it's because the inflation data keeps coming in hotter than expected. And if consumers are spending more and more on food and energy, they just have less, and rents.
Right.
They have less money to spend on other things.
And they can't get credit because it's expensive right now to get money.
Right. And as they buy less stuff, this is also having an impact of a bigger and bigger detraction from GDP due to inventories. Companies bought a bunch of stuff because they thought people were going to buy it, and it was stuck in the Pacific Ocean for a really long time. And then they finally got it on their shelves, and now it turns out consumers don't want these things. They're shifting from goods to services. And increasingly, there just isn't demand for them because consumers don't have enough money to spend. And so you're seeing a big inventory draw. That, and then finally what's going on in the residential investment line item, which is brokerage commissions have just totally, I mean, you don't want to be too dramatic, but they've slowed dramatically because there's just less buying and selling activity.
Yeah.
If you want to, I mean, with how much mortgage rates have gone up and how hard it is to get a new home, people just aren't selling and people aren't buying.
Yeah.
The Fed has essentially frozen the housing market.
Yeah, and I think we've started to see that substantially in a lot of metro areas. There's still some areas that are doing well, but it's coming.
Yep.
The other element, I guess, to just talk about here is why are the GDP forecasts so dispersed? Like, we have people who still are calling for 3+% GDP growth.
Yeah. Well, I mean,
what are we missing here?
They're slow to update their models. It seems pretty much baked in the cake that Q2 is going to be near zero or worse.
Mm-hmm.
You said before, inventories are very difficult to predict. They're one of the most volatile elements, that and net exports. And so, especially with everything going on in Russia and Ukraine, and China, how much are we going to sell to other countries versus how much we buy? So there's probably going to be more forecast error this quarter than there has been historically, because those two volatile items are really swinging it. But still, update your models. Yeah.
All right, so our composite recession forecast has hit an all-time high here.
Yep. 68.9%, so that's slightly up from where it was at the end of June. And what I think is probably more interesting to look at is why this has gone up, because different things are starting to contribute to the recession forecast. This is something we've been talking about all year. Eventually, the recession forecast is going to shift from the market-based variables, things like the stock market and high-yield bond spreads, and it's going to shift to the actual hard economic data deteriorating, and it'll become less volatile. And we're just in the early innings of that sort of handoff. One thing to highlight, it's about halfway down the page, new orders to inventory ratio, because it speaks to everything we just talked about with GDP now. So this number, new orders versus inventory, if companies are buying more stuff and inventories are low, this number is above 1, and that's great. Then we should have an inventory build, and that contributes to economic growth. This is the first time since COVID we've seen it dip below 1. It's now at 0.9. So new orders are slowing. People aren't buying as much stuff, and inventories are building. And that has preceded basically every economic recession for as long as you can remember. You have an inventory glut. And it also speaks to inflation coming down, at least for goods, because people have too much inventory and they got to move it. They need to cut prices.
Yeah, I mean, anecdotally, we're hearing stories of people who are buying stuff and trying to return it, and the retailers are saying, you know what, just keep it. It'll cost me more money to take it back from you.
Yes.
So just keep it.
I do not want that in the warehouse. Yeah, for sure.
I do not want it. Okay, so let's move on to earnings estimates, because this is, we think maybe the last shoe to drop here, or one of the last shoes to drop here. Like the earnings estimates based on all this haven't been coming down.
Right.
So maybe why is that? Like, what are the analysts? We know they're historically slow, but they're looking at the same data we're looking at.
Yeah. The economic data has been really coming in worse than expected pretty sharply for a pretty short period of time. So it hasn't been deteriorating all year. So that's fair. There's a bit of a lag. And we showed this chart in the last video shoot and was sort of like, hey, look, they haven't come down yet. They should come down.
Right.
And I think what we've painted with GDP now, recession forecast, inventories, everything, it makes sense that it should come down. If we look at the next chart, this is sort of, you don't have to take our word for it. It's pretty much baked in the cake here. Estimates need to come down, if for nothing else, because the dollar is extremely strong. Yeah. Extremely strong. So this blue line, this is the US dollar index, the DXY. And it's inverted. So when the blue line's going down, it means the dollar's getting stronger. Dollar just reached parity with the euro. So it's been strengthening quite a bit. Why is the dollar strengthening? Because the Fed is hiking aggressively, and our short-term interest rates are much higher than everywhere else, and economic growth is slowing. Both of those things suck in dollars from around the world. and demand for dollars is high, so dollar gets stronger. As that's happening, the green and red bars, those are global earnings revisions. Just about every time when the dollar is strengthening, especially of this magnitude, earnings get revised down, estimates get revised down. That is coming.
Yeah.
So no doubt this quarter's earnings, next quarter earnings following, you're going to hear a lot of change in tone from executives about things like the dollar, about inflation, commodity prices, demand, inventories, all that stuff.
And so most of the sell-off we've seen so far this year has really been more of a multiple discussion.
Yeah.
What if earnings come down $20?
Yeah.
10%.
So one narrative that's starting to emerge is, hey, all this bad news about inflation and the Fed is priced in. And so stocks look cheap relative to earnings. That's just because the earnings haven't come down yet.
Right.
So if the earnings come down on that magnitude, now, stocks are down 30%, but relative to earnings, they're actually not any cheaper than they were to start the year. And nobody was talking about stocks being cheap to start the year. Right. So that narrative, that valuation narrative, hey, I know there's bad news, but things are cheap relative to earnings, that should start to fade.
Mm-hmm. And so we hear people talk about, well, the stock's down 90% already. How can it go any further? Well, it can go further.
It could, or it could just stay down.
Or it could just stay down.
Yeah.
Right. And I think the last point, we talk a lot about interest rates going up. With the slowing economic growth, interest rates have already really risen.
Mm-hmm.
So maybe just as a reminder, refresh people, because we get this question a lot. When we talk about interest rate going up, we're talking about the very, very front end of the curve, not the long end of the curve. So just give people a primer on that.
Yeah, the Fed is hiking interest rates. They're hiking very short-term interest rates. The Fed controls every interest rate basically within 3 months. Okay. And then that influences bond yields within 2 years. 2 years and out, that's controlled by the market. And so what you have is this dynamic now where we're getting more and more yield curve inversions because every bond yield 2 years and out is not moving as the Fed is hiking. It's saying, hey, I knew you were going to hike. I already priced this in. That's why the 2-year yield already jumped.
Right.
So it's just staying put. 2 years and out, staying put. The 30-year isn't going anywhere. Saying, hey, I saw this all coming. I priced this into Fed futures. This is exactly what we thought. And all that's happening is shorter term interest rates are rising. So you're getting more and more yield curve inversions. It's likely that by December, the entire yield curve will be inverted. The last interest rate to rise will be the 3-month point, and it'll go up to 3.5%. And that is above every single maturity on the Treasury yield curve.
Currently today.
Every single other one. Yes, exactly.
So I think that's an important concept, and we'll obviously keep you posted on that stuff. If you have any questions, we're certainly happy to discuss it with you. Thanks for joining us today, and we'll talk to you at the end of July.